Today, we have a very special guest, Mo Lidsky, who is a serial entrepreneur. His latest business, which advises over 250 of some of the world's wealthiest families with about $23 billion of assets under advisement.
So I gave him a number, 25, 30,000, something like that. And then he says to me, "Oh, that's it." And I was like, it just dawned on me that I made a colossal mistake. And I'm like, oh, I mean, per location, of course. Thinking to myself, like, you greedy little bastard, you should have just taken. I was going to shut down the thing anyway. A week later, he showed up. It was like a scene out of a movie with like duffel bags of cash. And he's like, I have 180,000 as a first deposit.
Do you have any lessons about that journey?
There was something structurally and fundamentally problematic with the way the financial service world or the wealth management ecosystem was structured. A lot of people spend a lot of time focused on the nature of the investment, how to navigate markets. Frankly, like that's uninteresting.
Like, how do you get someone to trust you with their money?
One of three things has to be true.
Mo Lidsky.
Yeah, thank you.
Good to see you.
Good to be here.
So take us back. Did you grow up an entrepreneur? What was your first?
No, no. I grew up poor. That kind of where it started. No, we were immigrants from the former Soviet Union, and after being refugees in Italy and Austria, we landed in the U.S. In Cleveland, Ohio. And my parents, naturally, as with most immigrants, struggled considerably when we got here. So, as it happens, I had motivated interest to start making money early, partly to help them, partly because I didn't know what else to do. So yeah, more or less from the time I was 12 or 13, was working full-time hours. Started my first company that had any real equity value at 17.
Oh.
And then, sold it, that first one at 19, and then proceeded to build, buy, sell, turn around, restructure a whole bunch of businesses over the years. And I found myself in this weird entrepreneurial landscape. I never planned on being an entrepreneur. I never held down a job. I'm evidently unemployable, but yeah, that's kind of where I am today. And by the way, a lot of those, any entrepreneur that doesn't have a whole bunch of embarrassing moments and failures and flops and colossal disasters either got massively lucky or has a roadmap I'm not familiar with. But there's a lot of missteps and ugly pit stops along the way. But, thankfully, I'm kind of blessed to be where I am today.
Right. So 17, so you became an entrepreneur out of necessity, it sounds like.
Yeah.
What was that first business?
Well, I think just to make a comment, I think that our laws, God bless American Canadian laws, which have limitations on when you could actually hire people on a full-time basis. They're meant to protect kids, but for kids who actually really want to work, they create an impediment. So I had to go up and down, retail plazas and offices and, residential homes, knocking on doors saying, "Do you have work for me?" And so I became that weird kid that was just, always showing up for work in Cleveland. Anyway, so that's kind of that puts you on an entrepreneurial journey. Mm-hmm. Because every single day you wake up and you're like, well, if I don't do it, nobody else will do it for me. Nobody else will send me a paycheck. So gotta just make it happen.
Right. So what was that first business?
Yeah, first business was kind of fluky. So I was in Israel at the time and I had another little business. This was during the period of the Intifada. And so bombs were going off in cafes, buses. So all the kids that came from North America to study in Israel, their parents didn't want them leaving campus to go do groceries, pick up things as necessary. So I created a delivery service for kids from North America, students who did not want to travel to other jurisdictions because they were fear of getting bombed, frankly. Mm-hmm. Anyway, along the way, that was kind of keeping the lights on for me. But in terms of that first business, I really needed to make more, and I didn't know how to make more because the delivery business wasn't generating all that much. So in Israel, and I guess in traditional Jewish communities, there's a couple times during the year where Jews actually cease from cutting their hair for extended periods of time.
Like right now.
Like right now, as it so happens, right? So they're either 3-week period or 33-day period, whatever. And so we were amidst one of those, and one of those was coming to culmination that Sunday, sort of like akin to this year. And I quickly realized I was walking doing the deliveries, and I saw a barbershop chair and a barbershop equipment on sale. And I lived in this little community of about 7,000 people. And it just hit me like a brick that, 2 days from now, 7,000 people were going to need haircuts. And there was no barber anywhere nearby. And so they were going to have to go to one of the big cities or just do it themselves. I said, well, there's got to be at least 20 schmucks there that just do not care about how bad their haircut is. If it's cheap and cheerful, but just somebody will do it for them. And if I could pay down the cost of this barbershop chair and this equipment, then all of a sudden I end up where I started. Now I have an asset to my name. Anyway, it was kind of a funny story because I had to, I will never falsely advertise anything. So I called the company Ukrainian Buzz. We ended up advertising it as the worst haircut that you will get. We ended up putting ads up. I had friends of mine draw ads where like, you know, scissors were being stuck in the hair, wacky mohawks, ears being cut off, all kinds of weird things. And so who knows what will happen? Anyway, there was like a lineup out the door on Sunday morning. And that lineup did not stop for days. And it just continued. And all of a sudden, after a while, it was still busy. And people would start to come from other little villages or settlements or kibbutzes that across Israel. And it sort of dawned on me that there were all these little communities that had that were demographically too small to have a permanent barbershop. And so there was an opportunity to kind of come in and soak up some of that demand. And, over time, so I started to put myself and other barbers on trucks and go drive across Israel, soaking up the demand, in some cases a day a month or a day a week. And over time, we had dozens of barbers across the country. And anyway, a couple of weeks before I left, I sold that business, which was a story in of itself. But that sort of got me started. And it actually, the person that came in to buy the business actually walked in. He was one of our customers. And he said, I'd like to buy your business. I was, in that mode for, I guess by that point in time, eight or so years, just getting jobs, getting work, getting paid for the work, even if I got other people to do the work. When he said, I'd like to buy your business, I didn't even know what he was talking about. I was like, what business? And he said, oh, the barbershop business.
You're 19 at the time.
Yeah, I'm 19. Yeah. And he says to me, I said, oh, right, that business. Sure. So he says, what do you want for it? And I'm like, what do I want for it? And I start thinking about the costs of the leases, the equipment, the space, the rentals. I'm like, well, what if I just broke even? Could I just get all that back? So I gave him a number. I don't remember, 25, 30,000, something like that. I don't know, maybe something a little more. And then he says to me, oh, that's it. And I was like, it just dawned on me that I made a colossal mistake. And I'm like, oh, I mean, per location, of course. And he's like, how many locations do you have? I'm like, well, I have 13 permanent locations and we have 18 part-time locations and And he's like, oh, geez. Yeah, anyway. And he's like, oh, okay. And then he walked away. I'm thinking to myself, like, you greedy little bastard, you should have just taken.
Went from one extreme to the other.
You could have taken, yeah, exactly. Just could have taken it, covered your costs and moved on. I was going to shut down the thing anway because I had no concept of equity. It just didn't even dawn on me. And anyway, a week later, he showed up. It was like a scene out of a movie with like duffel bags of cash. And he's like, I have $180,000 as a first deposit. Will you take it in installments?
My gosh.
And I'm sitting here. I'm like, okay, don't say the wrong thing. Don't say the dumb thing. So I start to negotiate with him. And I said, that will be okay, but on one condition, that I get every penny of our earnings until the day I leave. Wow. And then I'll accept your payment plan. He's like, yeah, okay, great. Okay, fantastic. Anyway, so it was pretty wild. When
you started this business, you weren't a barber. You had no training. I assume you just like did it.
Yeah.
That's pretty crazy. Cause I love those kinds of stories where you have an entrepreneur just finding like a gap in the market and just do it. Yeah. That's like the best way to start a business, I think. You're right.
Yeah. I mean, in future businesses, I started them with like a little bit more of a fundamental understanding of what was going on. Like, no, I had no concept. The thought process was I passed, as I was walking to the central bus station, there was a tiny little flea market and they were selling barber equipment and barber chair. And I thought, how hard could it be? And it just so happened that the only thing I could afford was like, that was the last amount of money that I had. I was down to like my last 400 shekels. It's kind of cost more or less that. And, I had to negotiate there too. But ultimately, yeah, it wasn't, what's the TAM of, the barbershops and, small settlement. None of that kind of, so anyway, it was a great outcome. And it kind of gave me some seed capital to go off and do my next thing.
I see a lot of aspiring entrepreneurs also overthink it. They do too much analysis and it kind of, there's analysis paralysis, and then they never start anything. And there's also the other extreme of it where,
For sure. Yeah. I mean, I think that starting any kind of business takes an enormous amount of courage. I think that one of the things people in any state of uncertainty, people react differently. Some people freeze up, some people overanalyze, some people just jump into action. And by the way, there's actually pros and cons of all of those approaches. But I think my bias has always been amidst uncertainty or stress, pause for a second and then quickly jump into action. So sort of just playing that out.
Mm-hmm. So you started Prime Quadrant like 10, 15, about 10 years later?
So yeah, I'll give you that story. So what happened?
Because there's a whole host of businesses and exits and everything that happened in between, right?
Yeah. So I'll just jump to the Prime Quadrant story. So what happened along the way is as I started to come into liquidity, also I got involved with my alma mater with Yeshiva University, and I was chairing the investment committee, and both with Yeshiva University and with my own capital, we went through 2008, 2009, the global financial crisis, and in both cases, me with my own capital and Yeshiva University with their capital, with me being sort of chairing the investment committee, we were caught with our pants down. I mean, it was incredibly exposed. Everybody ended up in the same place. All of my advisors ended up in the same place. It seemed to be useless kind of amidst that crisis.
They never prepare for a black swan. They don't think about.
Yeah, it was a combination of black swan, systematic risk,
overexposure, maybe to equities.
Yeah, lots of everything that, in retrospect, we could be Monday morning quarterbacks about, but are actually basic fundamentals. But what I recognize that I was naive. I mean, I was in my 20s, right? So I was green. I was an arrogant little punk. Like,
not more than me at that time. I just turned 18 when this whole thing was collapsing. I took a little bit of money from family, traded on margin. I bought leverage ETFs. I was like buying and selling city stock while I was going up and down. And Bank of America, I was like, I know I can time the market. I know how to read charts.
Yeah.
I'm this little donkey in the shul of business. I thought I knew how to read, financial reports and all that. And man, I lost a lot of money very quickly, $10,000 very quickly. And it was like such an important lesson for me, man. I didn't get into the stock market until 2020. Wow. That's the next time I entered the stock market.
Yeah.
Did much better than that.
Which is the unintended consequence of it, right? Like people get burned and then they actually stay out of the market, which again, further harms their financial interests. But in my case, I didn't actually play the markets at all. It was really me thinking because I've had some early successes, I sort of thought I was God's gift to, sort of business building or wealth creation. And you had
reason to believe that you were doing really pretty successful.
Nobody has reason to believe that, but it was. I guess I was slightly overconfident, but I think that that year 08, 09, I ate just an enormous amount of humble pie, and so at the same time, notwithstanding my arrogance coming into that period, on some basic level, I knew that I was clueless. I knew that I was sort of starting out, but on my board, in that investment committee for Yeshiva University.
How many people were on the investment committee?
Oh boy, I think there must have been like 10 to 12. I don't remember exactly. 10 to 12 members of that investment committee.
And just hide behind everybody else's mistakes too?
Yeah.
Distribute that responsibility?
You know what? Well, first of all, I was the chair. So I remember, but I was the most insignificant pipsqueak in the group. Everybody else was like titans of industry, names that if I mentioned to you, you would know who they were. And I'm sitting around and I'm thinking, okay, guys, like I'm clueless. How the hell did we get here? And like everybody is like shifting uncomfortably in their chairs. And I'm like, okay, I see that question is too difficult. Forget how we got here. How do we get out of here? And they're like, back to navel gazing. And I'm like, okay, I see that question is too difficult. Just, I'm a small, insignificant speck, but you guys, you're all captains of industry. What are you doing with your own fortunes, which are colossal? And again, everybody's like back to, mortified shame and whatever. And so it was kind of at that moment that it dawned on me that there was this fundamental divide between the art and science of wealth creation and the art and science of wealth preservation. They're like two different worlds. Because here I had the greatest wealth creators that I knew, and they were just at a complete loss, like just totally unsure about how to navigate forward.
Was it public how much like Yeshiva University? I assume this was like their endowment.
So yeah, there were several endowments. So Yeshiva University had an onshore endowment, which was about $1.7 billion at the time. I don't know how big it is today. And then there was offshore endowments. So Canada would have its own, UK, Israel. Others would have these smaller offshore endowments. So I was responsible for the offshore endowments, not the onshore. So again, substantially smaller. But the one thing that was kind of funny about that whole period was, it wasn't funny, it was tragic. but Yeshiva University was one of the largest victims of the Madoff affair.
Right.
So they lost about $115 million.
Oh my gosh.
At least on paper. I mean, in practice, it was substantially less in terms of what the actual dollars that were put in. But, with our portfolio, made every mistake. Like, I literally had no idea what we're doing. Our advisor was mediocre at best, our external advisor. And all of a sudden, I started to get calls from the board of governors, from the investment committee in New York, and I started to get summoned, and they bring me in, and I'm like, oh, hell. Like, like I knew I shouldn't have stuck my nose in this. Why did I get involved in this? And I'm thinking, like, they're just going to give me hell. And so I get there into this meeting. Everybody's there, notebooks wide open, sitting there with bated breath. And they're like, hey, what do you want to know? They're like, well, how did you know? I'm like, how did I know what? Like, well, how did you know to avoid Madoff? I'm like, is that why you brought me here? They're like, yeah. I'm like, you really want to know?
You don't trust Jews.
He never asked me. He never bloody asked me.
I would have said I don't trust Jews.
No,
That's what I said.
no, come on. So anyway, they're like, he never asked you? That's it? I'm like, yeah, that was it. Drop their pens, get this guy out of here. Like, what a waste of time. But no, so it was interesting. On a relative basis, we actually looked better, notwithstanding we did everything wrong. But I think, so that one, there was this recognition that there's a fundamental divide between the art and science of wealth creation and wealth preservation. And then two, I had all the advisors I had around me were, as I said, ended up with, it would be charitable to call it lackluster results. It was a colossal.
Like they performed worse in the market, or was it just
they all in and around more or less? Okay. But then on top of that, they were all sort of baiting me into decisions that I think were behaviorally problematic, and also had no consideration of what was going on for me in my operating businesses or assets, what was going on in other parts of my financial world. And
is this personally and the yeshiva?
Personally, primarily personally, yeah.
Okay.
And so, in the aftermath of 0809, in the aftermath of that experience, I sort of said, okay, one of three things has to be true. Like, I have made every dumb mistake in that period. I lost an extraordinary amount of money. I'm sure it was a lot more than $10,000, a lot more. And we had, a partner and I had a fairly sizable portfolio of industrial real estate and some other assets that went belly up. And so I thought as I said, one of three things had to be true. Either I really didn't understand how to leverage the financial service world, or I just had this gift for surrounding myself with like the big village idiots of the financial service world, or there was something structurally and fundamentally problematic with the way the financial service world or the wealth management ecosystem was structured. And I just couldn't understand what it was. So I went on initially a search for new advisors, but it was also a little bit of a curiosity. And that curiosity became a whole hog obsession. I ended up spending 8 to 10 months going up and down Wall Street and Bay Street trying to find better advisors and meeting hundreds of people throughout that period. Anybody that touched capital in any way, shape, or form. I want to understand who's who in the zoo and how all these pieces fit together. At the end of that walkabout, what quickly occurred to me was that it was very unsatisfying, eye-opening, but I still hadn't hired a single advisor. Mm-hmm. And part of it was I started to realize that 100% of the people I was meeting with were either in the business of gathering assets or in the business of transacting with assets. Mm-hmm. And there was nobody who was in the business of just providing unbiased, conflict-free advice, independent of where those assets may sit, independent of any transactions. And so when I reflect on that, like, well, that seems problematic. Like, somebody should be able to offer advice. And there were also gross limitations about what that advice was on. Like, most people were offering advice on stocks or bonds, or if they're investment bankers on private equity or real assets or whatever. But like, nobody kind of bridging those worlds. And also nobody was really thinking about how do you bring together holistically all the different concerns and anxieties of an affluent family's circumstance. I've had a charitable foundation since I was fairly young, a personal charitable foundation that was always very important to me. Cross-border considerations, et cetera, et cetera. And so when I pieced it together, I was really thought, there should be like a McKinsey of the family office world, or a McKinsey of the private investor world. And anyway, when I couldn't find it, I said, well, hell, if it's not out there, how bad could I be at building something like that? And so at the same time, I had a mentor, a friend of mine, who we were involved in quite a few charitable projects together, and he was somebody that had been investing his own family's capital for many, many years. And we got to talking, and he was had a similar experience and came to a similar conclusion. And so why don't we do this together? And so that was kind of the genesis. And he was effectively my mentor, and I was the sweat and blood and tears that would kind of make it happen. And that was kind of how we started.
How'd you get how do you get someone to trust you with their money? Because these are probably the most discerning and sophisticated people out there when it comes to creating wealth. How do you get them to trust them? To trust, how do you get them to trust you?
Yeah, I mean, I think that it's a great question. I mean, it wasn't like I actually ever set out and said to myself, how do I get this person to trust me? That thought actually never crossed my mind. Because I started in this industry from a point of frustration, and I realized that there was an incredible amount of opacity. So, the clients were sort of structurally disadvantaged because there was how do I phrase this? Years ago, there was a guy named George Akerlof that actually wrote a paper for which he got a Nobel Prize, which is called the market for lemons, which means in any market where there's an asymmetry between the amount of information that the seller has versus the amount of information the buyer has, the consumer will be consistently taken advantage of in that circumstance. In financial services, financial markets, especially high finance, there's a profound asymmetry of information. And on top of that, sort of opacity around the structural execution on that information. So, and I quickly realized that all I had to do, I didn't actually have to convince anybody. I just had to get the information and help people understand what it was that they were missing, what it was that they didn't know. And the second you show people, oh, by the way, you're leaving all of this money on the table. Here's a more efficient way for you to do the exact same thing you're doing. Mm-hmm. And if it's 0.5% of savings for the families we're dealing with, it's millions of dollars. And then, oh, by the way, there's a better alternative to what you're doing, and here's what it is. And I don't have a dog in the fight whether you do it or don't.
Because you're a consultant.
Because I'm a consultant, right? So when all of a sudden what you do is you widen their aperture and you present on a silver platter the information that they themselves so desperately need and want. They just don't know where to get it or how to access it. All of a sudden people are like, oh, this is great. I want you in my corner. Sit next to me as we continue on this journey. So really, again, the thought of how do I get somebody to trust me never crossed my mind. But it was the entire Vault and Chunk, the entire sort of ethos of what we're trying to do is empower people and help them make the best decisions that they can make. And people get that. They feel that.
That's quite interesting. It sounds like, if you do a good job, meaning if you provide good advice, I assume these types of people, they verify and validate. And then once you show yourself that you're competent, they give you more work, and then you get referrals, and then that kind of compounds on itself, right?
Yeah.
One of the few things, it's very hard for people to comprehend compounding, whether it's financially or otherwise. If you do a good job for someone, the effect of that is almost hard to quantify, because that can lead to another customer, it can lead to another customer, and so on and so forth. And the opposite can happen if you do a terrible job or you're not competent or whatever. Mm-hmm. Sounds like that's what happened, right? You started off, I guess, with a few clients, and then just
yeah. I mean, it's interesting. I can't believe, and I think I told our first client, who is an old friend of mine, I think when he told me, I'd like to join you, I think the words out of my mouth were something like, it's the most reckless thing that you could do. Because, frankly, at that time, I didn't know anything, mm-hmm. And it was just my partner and I, and we had one or two people that sort of in the office. And we were starting out. I mean, I was so clueless. But I think people are pretty good at reading your integrity. People are pretty good at reading your intentionality, especially if it was people that you have done business with before. So along the same lines you said, our first client actually, he knew I knew nothing about this domain. He knew that. But he said, Mo, I've dealt with you before, and one thing I've been looking for from my financial providers is somebody that underpromises and overdelivers. Somebody that, when they don't know something, they figure it out or find somebody who does. And somebody that's always going to look after my interests first. Put my interests first. He said, that's it. That's the bar. He said, I know you're clueless, but I've also, through our shared experience working together, I know you're going to put my interests first. I know you're going to hunt down the answer. And the expectation can't be any lower. So I was like, okay, good. That works. But, from there, obviously, What's also amazing is every single year as the business evolves, every year I think about the year prior and I'm mortified about what we looked like last year or the year before. I'm like, oh my God.
Can't believe I did that.
I can't believe I did that. Like, what were we thinking? Why did people like entrust us? Like, so I think that that's a perpetual journey. I think that's a reality that as people evolve and improve, you're always, you should be slightly embarrassed of your past self or recent past self. I think that's just normal part for the course.
Mm-hmm. So today your business is doing, because we spoke about it before, you're doing tens of millions of dollars in revenue. You have 140 employees or more at this point, right?
No, we have 100-ish full-time, and then there's a whole bunch of part-time and across 5 offices. Yeah.
Right. And you're directly managing several billions of dollars. That's pretty incredible just in and of itself as a business story. Do you have any lessons about that journey that you can share with, the people that are listening? Because I tend to think every industry is different. There's different elements, right? But the core of building a business is relatively the same no matter which industry you're in. So I'm sure some of the lessons you've learned along the way could be helpful for other people.
Yeah. I mean, I think that, my mind goes to a couple places. I mean, we've been speaking about the sort of the client side of the equation, and that's important. I think a very simple principle is always deliver way more value than you're paid for. And, there's a catch-22 there. It's actually, you want to keep increasing prices constantly. But you got to be, if you're increasing prices, you got to be increasing the value proposition at 1 point X plus or 2X plus, like some higher multiple of
than the price increase
right. At all times. And you also have to be, your learning velocity has to increase as well. So it's not like, oh, you're going to be paying me for the same old me, and not just me, some of our team members, but really pushing our team members to learn and grow and evolve so that who they're paying for next year is actually an upgraded version of who they paid for last year. So I think that perpetual desire to both increasingly add more value, even if you're not increasing fees, always adding more value, and increasingly evolving the talent density. Sometimes that means improving the people that you have. And sometimes that means hiring better people that will either raise the bar or filter out those that perhaps don't cut it anymore. Mm-hmm. And that is difficult. That is, every company that's growing starts out when you're a small little sort of 1 to 5, 1 to 10 person employee. You will take anybody that's willing to work for you and sort of buys into your vision and sort of scrappy and will tolerate, kind of a organized but mission-driven organization. But all of a sudden, as the organization grows to 25, 50, 75 employees, all of a sudden you have some structure and organization and management and delegation of both resources and management duties. Like there's some people that just don't cut it anymore. And it's hard. It's hard confronting the reality that the people that you started with, the ones that got you here, won't necessarily get you there. And it's even harder to look yourself in the mirror and say, am I the right leader for this moment? Mm-hmm. Maybe I was the right leader to get us here, but maybe I'm not the right leader to get us there. And at minimum, look at what it will take to get somebody there and say, could I evolve to that? So that level of both collective awareness and self-awareness at every level of management and leadership is sort of critical. And then that level of, I would say, quality control or rigor from an executive or a CEO is also equally critical. And I've made the mistake of tolerating mediocrity for too long, not firing people fast enough. I hope not to make that mistake too many times.
It's interesting because I'm a VC, right? When we make investments in startups, we never do so with the intention of getting rid of the founders, even if we have the ability to, which most of the time we don't. But some founders they don't have the skill set to build a multi-billion-dollar organization. They can get a business to maybe 50 million or 100 million, which would be great. But some of them just can't. There's some data out there suggesting that probably not good to get rid of a founder anyways.
Right.
But that's a real thing. Like it's a very unique skill set to be the leader of a 50-person organization versus 1,000 person versus a 10,000. It's completely different.
For sure.
And the people that can really, I've met a few of these people in my life where they're just so exceptional. They can really lead 10,000 people organizations. And you can see the kind of value they bring to the table. It's like, you understand why they get paid so much. It's like you take them out of that business, the business is much worse.
Yeah, 100%. And again, a lot of those people, some of those can't do the 0 to 1, right. As well. I'm one of the more valuable elements of my life over the last, call it decade and change has been, I've been fairly active in YPO, Young Presidents Organization, which is, and I'm constantly learning from peers, other CEOs of different businesses, and some of them, you have people in your forum with thousands of employees, and then you have people who are like intergenerational family business, and some that are just like, guys like me who sort of start something from a negligible nothing to something that's hopefully meaningful. And there is so much wisdom that I'm gleaning all the time from a lot of those professional, like hired guns, professional CEOs that are able to sort of really run a colossus of an organization. There was nothing in my training that gave me that capability. If you took me 7 years ago or 10 years ago, threw me at a 10,000 person organization, oh my God, how quickly I'd be blowing stuff up would be extraordinary. I mean, it would be the most efficient evisceration of value in modern history. But I'm actually learning, and I'm learning what it will take, because as our company goes from 100 to 1,000 employees and whatever else, those are practices and disciplines that if I can't keep up, I got to move out and bring somebody else into this.
There's a prospect you may fire yourself.
I'm ready to fire myself every day. Yeah.
To the extent that you have an investment philosophy, what is it?
I think, again, the investment philosophy actually is quite simple. One is recognize that finance and all the tools of finance are nothing more than a tool, and that every investment has to be structured in alignment with the objective that it is in the service of. And so a lot of people spend a lot of time focused on the nature of the investment, how to navigate markets. Frankly, like, that's uninteresting. What's really interesting is, like, what is this particular family or this human trying to achieve? And then, given all of the tools of finance that are out there, what will give them the highest probability of achieving that? Mm-hmm. And then what are they trying to avoid? And how do you minimize the probability of them ever confronting what they're trying to avoid? So to do that, you, number one, have to have, first of all, a total portfolio approach. Number two, you have to be non-dogmatic about any particular asset class or strategy. Mm-hmm. Everything will have its day. You can't be, the problem with when you go into and you talk to asset managers, it's almost like you can have like the Maslow's phenomenon, which is like the man with a hammer, everything looks like a nail, It's, you got to recognize this. Sometimes you need a hammer, and sometimes you need a screwdriver, and sometimes you need it. So whether it's venture or some kind of default swaps or, some student housing or whatever it is, they're tools, and there's a job to be done. And the question is, have you sufficiently articulated the job to be done, and who's the best to do that job, and to maintain accountability over that dollar doing that job? Mm-hmm. And so it's really just taking a very business-like approach and taking a sort of an enterprise-like rigor to the to portfolio management. And then, obviously overlaying that with not having exogenous agendas that sort of, or conflicts or biases or misalignments, having a sufficiently appropriate time horizon that corresponds with with what you're doing. These are kind of like motherhood and apple pie. These are simple, straightforward things. So
much harder to do in practice, to remove biases and not to be captured by incentives that don't exist all over the financial industry.
100%, 100%. But that's why we set up our firm the way we did, so that we try to avoid as many conflicts as possible. Mm-hmm. Nobody's perfect, but we're certainly not. But I think what we're trying to do is set the conditions for maximum success for our families, and try to minimize any other any noise that might water that down.
So touched on venture capital briefly. Of course, for me and probably people that are listening, venture capital is either what they need to think about because they need to raise capital, or it's what they do because they're venture capitalists.
Yeah.
What's your perspective on the venture capital industry? Is it, because I know a lot of institutions are lacking liquidity, so a lot of family offices are getting into the game either directly or through venture funds. Is it an asset class that you encourage in the right, for the right families that you advise? Has your perspective changed on venture capital?
Mm-hmm. Yeah, a lot of good questions. So first of all, venture capital, why I personally like venture capital, it really allows people to place, it's effectively a call option on a future that most people don't understand, because they're not spending nearly enough times at the frontiers of technology. So if anybody wanted a call option on a future that's different than the one we're experiencing today, venture is arguably the best way to do that. Now, the challenge with venture has always been the dispersion of returns between those at the top of the heap and those at the bottom of the heap, right? So in other words, and that dispersion has always been widest and probably will continue to be widest in venture than in any other asset class. At one point, I remember, I haven't looked at the data in years, but at one point, it was something like the top 50 VCs, and this may have been like a decade ago, but the top 50 VCs at the time were like gobbling up 98% of all the returns that were generated in venture capital, all of it, which means everybody who wasn't the top 50 were just like picking up crumbs.
And those top 50 are probably involved in the same 10 deals.
Yeah, exactly. So I think that, I think it's not as extreme today because you also see a lot of specialization in venture, which you didn't have back then. So somebody will go into biotech, will be different than the person in cyber, will be different in fintech, sort of femtech. Everything, there's a tech everything. And all of a sudden, there's these niche groups. The reason, so what that means is that if you're good at adjudicating who's quality, you're going to do really well. And if you're not good at adjudicating who's a quality VC, you're going to do really poorly. Now, what's interesting about, there's the talent side of the equation in terms of VCs, which is interesting. What I think is most intriguing, which kind of surprised me when I got into the game, was that it's the best technology doesn't necessarily win. It's the most connected technology and talent that wins. And so what ends up happening is like venture becomes this extremely unique marketplace where legalized insider trading actually determines who wins or loses the game. And if you happen to know that this Fortune 500 company is adopting this technology and you happen to have an in and be able to, or
it's like Mark Andreessen sitting on the board of Facebook.
Yeah, exactly. It's like,
they're buying up WhatsApp or whatever they're buying, it's like.
What's amazing is you have these dynamics where you could have, kingmakers, and some VCs are, who will actually create self-fulfilling prophecies in a way that you couldn't really do in any other asset class. So then the who becomes infinitely more important than the what.
I see, right.
And people are always important, but in venture capital, it's like ludicrous how much I would over-index on that versus everything else.
Interesting. So there's a couple of things there. It doesn't sound like pure historical performance is the only way you would measure a VC investor.
For sure not. But I think that it is a great indicator. It is it's a symptom. And then you also, it's not just performance, it's the persistence of performance. So it's like they did it over one fund. Well, okay, they could have gotten lucky in, sort of one deal that returned the fund, but then they have no structural advantage or edge going forward. But if all of a sudden you see them and they're like on fund 6 and they've had like colossal outperformance, that alone is a pretty strong indicator. They're doing something right. So, right. So it's largely a function of, how persistent that's been. But then besides that, what are the network effects that exist around it? And that's everything. Network effects work from everything from origination to ultimate disposition to future raises to all, there's a lot of pieces that are involved. You asked another question. I'm more excited about venture today than.
Yeah. Has your perspective on venture changed?
I don't think so. I think what's interesting today, and it's, again, it cuts both ways. Keep in mind, I was kind of a venture entrepreneur, right? So I wasn't a VC, but
you're a founder.
I was a founder. I was going to VCs. Yeah. I actually had a commitment from a VC way back that he went bankrupt and couldn't honor his commitment to me. And so that was a company I had to fold. Anyway, another story for another time. But, when I was starting companies, like I couldn't imagine starting a company with just me and my laptop 20 years ago. I had to think about, well, I'll need at least, $250,000, $500,000 of startup capital. And I have to do that. And I hire my first team and then they have proof of concept, build some minimal viable product, convince somebody to pilot it, whatever. And then maybe do a friends and family or a seed or whatever, and then hire more people. And it was, today I'm seeing entrepreneurs that have like, multi-million and even sort of decamillion revenue streams with just like one or two people and a laptop, with the assistance of AI. It's just remarkable. I mean, I think we were chatting a couple of weeks ago. I was in at HBS and met an entrepreneur that had a $50 million company.
HBS, Harvard Business.
Harvard Business School. Yeah, it was met an entrepreneur that was $50 million company. It was just him.
What?
And it was and it was a really simple business, and he basically automated, the fixing of websites of small businesses that were just like busted up. And so everything from, reaching out to the entrepreneurs to like engaging in them, negotiating with them, delivering product, expanding scope, expanding, offering another product. It was all done by an agent from beginning to end. The guy never touched anybody, never spoke to anybody. He was just managing the different agents that were part of that equation. And
an AI agent, for those of you that don't know, AI agent will just, you set its task, it learns, and it does the activities on your behalf.
Yeah, so that really opened my eyes to a completely different way in which you could, startups and VCs could orient capital allocation. It was mind blowing, candidly, and subsequently I saw many other companies, not quite of that magnitude, but things of that nature, which was just earth shattering.
I've seen a lot of that as well. It's taken when you do something, I've been in VC for over 10 years now. It's a bit hard to wrap your head around some of these changes, which are quite fundamental. Like it's taken me about a year now to reorient the way I think about startups, because I use a lot of signaling to cut down how much time I have to think about a startup to get to a point where I need to invest more time into them.
Right.
I'd rather just say no as quickly as possible.
Right.
And one of the proxies I used to use was how much employees did they gain over a certain period of time. Mm-hmm. That's a proxy for growth and progress and all that stuff. Today it's the opposite, because I'm seeing like you, I'm seeing generally my world is between $500,000 to $5 million in revenue. Mm-hmm. And where before it'd be 10, 15, 20, 25 people in a business of that size, now it's like 3 people, 4 people, 5 people, maybe max I've seen is like 8, where it was like still good. And yeah, that's like, now it's a red flag to have too many people. But
yeah, exactly. It's really the question, and we actually had this come up in one of our executive meetings earlier today, was, whether we should put effectively a moratorium on hiring just to force people to first conceive of an AI generated solution or an agentic solution before doing what comes naturally, which is, we just hired like 20 people over the last 2 months. And that was just like, that was a reaction. We have this capacity need. We're going to hire 20 people. Well, what if we just said, yeah, we have this capacity need, but we can't hire anybody? I don't know what that would have looked like. It would have caused a lot of tension and friction, and maybe freaked out a bunch of folks. But maybe that's something that we have to experiment with in order to figure out how to fully leverage the potential of AI.
Mm-hmm. So Prime Quadrant, I assume, doesn't invest directly in startups. To the extent you're involved in that ecosystem, it's through VC funds?
For the most part, yeah. Actually, just this week, we did a pretty significant co-invest with one of our VC partners, which I'm actually quite excited about. But that's
directly into a startup.
Directly into a company, yeah. Mm-hmm. Yeah. But that would be rare. Mm-hmm. Typically, we're trying to find the best VCs that we could partner with. And and we've been blessed to have partnered with a number over the years.
That's great. So if I read it, because it's very important for people like me, is that you look for obviously past performance. It's an indication of future performance in some ways, even though that's not, it's a good indication that they have the network, the leverage, they have some insight, maybe some specialization. Is there anything else, like when you meet with them, is there personality, is there values? Like what else are you looking for outside of the historical performance, or some of those leverage points you talked, like that network that's very hard to access?
Yeah, I mean, I'll come back to the network in a second, but yeah, I think I'm always, and again, keep in mind, I am not the sharp edge of the wedge on this. In other words, I have a research team, an investment team. It's largely their function to go out and find these opportunities. Of course, things come to me. I just pass it on to them to kind of take it the next leg of due diligence and benchmarking and so on and so forth. And I'm just kind of a modest member of the investment committee, and sort of ultimately approving these things when they come out the other side. But I think in terms of what I personally look for, I look for people that have a pretty firm foot in the future as well as a firm foot in the past. So, people who are, all of venture on some level are making a bet about a future that we are not yet experiencing today. And innovation that, has not fully monetized itself today, right? If it was, it would be a private equity deal or whatever else. So you really need to make sure that, number one, they have some kind of depth and authority by which to make that assessment, and almost like a passion in and around the domains in which they invest. So again, foot planted firmly in the future, but also they need to have a foot firmly planted in the past, because of course there are things from either a technological or a market point of view that do evolve and evolve drastically, but then there are a whole bunch of things that really don't change. And if people don't actually understand what has worked historically in sort of building, managing, supporting people, executing, raising capital, whatever it is, the likelihood that they'll succeed, just being some kind of like untethered visionary, tends to be fairly slim. Just coming back to the network, I mean, this group, and I'll just mention it with this, that we just did, this co-invest group. I'll give you, they're like a great example. So the group is called 8090, and
That's Shamoth Lapatia?
no, Karim Osman was the founder of it. So Karim's family, the Osman family, they're the founders and owners of a company called Sierra Nevada Corporation, which is one of the largest sort of military aircraft defense companies. And he sort of started an incubator within the family business, incubating technologies that could be creative and beneficial to Sierra Nevada. And then he started meeting with other next generation members of families like the Koch family and the Walmart family, and the Wrigley family, whatever it is, these big families. And they all had technology. They all want to bring innovation into their business. The next generation is also very focused on decarbonization. They are focused on data. They're focused on a lot of things that perhaps previous generations were not. So what Karim really wisely did was he basically said, look, we're going to aggregate a bunch of LPs. We're going to be part of this next generation, and we're going to source these companies together. Condition is that you sort of implement them in your very large, globally recognized family businesses, the experiment. So, I mean, you could understand, I mean, you've been around the venture ecosystem. What happens to the valuation of a startup before it has Walmart as a client and after it has Walmart as a client? Right? Like, so again, this is a classic example of, kingmaker dynamics. And so when you could align networks, smart, sophisticated capital, right, with really cutting edge entrepreneurs, a lot of magic happens. And so, yeah, that's sort of some of the things that we look for. And then obviously nothing substitutes good, honest, hardworking people that you actually want to be spending time with. Maybe in a social construct, but really more just like people you respect, people you admire. I've learned the hard way many times. There's no such thing as good returns from a jerk. They may come for a while, but eventually they perish.
That's great advice. You've written 4 books, and you're about to publish your 5th book. What would be the book you recommend that you've written to entrepreneurs or VCs or anyone that's looking at investing in the market?
Anybody that's looking to investing in the market.
In a way that's a professional way, similar to what you've done.
I think one of the things that, so one of my more recent books was called Selling Snake Oil. It's investment lessons from the world's greatest frauds.
I love the cover of that book, by the way. It was like a tie with like a...
Yeah, like a snake form. Yeah.
That was great.
Look, I think a lot of people...
Which we will share, by the way, links to all these books in the comments below.
Yeah, thank you. I think people learn better by case studies than they do by sort of theoretical concepts. And the best way that they learn case studies is by learning what not to do, like horror stories. So I basically took 50 horror stories and extracted the most salient points from them that I think are important for any kind of allocator or steward of capital to consider. And I think that would be the most broadly applicable book in the mix. Some of the other books are more intended for ultra high net worth individuals and investors, like Partners in Preservation. One is more philanthropically oriented. The next are more relationship focused. But the book I always want to recommend is going to be the book that I'm working on next. not even the one I just published, but the one I'm working on next, because I write not for producing some kind of Pulitzer Prize masterpiece and hoping everybody will read. I write for myself. It helps me crystallize my understanding. And what I'm most passionate about is the thing that I don't yet fully understand. And so the 6th or the 7th or the 8th or the 9th books that I'm sort of working on concurrently are far more interesting to me than anything that I've produced in the past.
Interesting. It's my last question to you today. I have many more.
Okay.
What is the best business advice you've received?
There were a bunch of advice. There were pieces of advice that I understood that I've received over the years that I didn't really understand until much later. And then there were advice that came from other sources that I didn't understand how applicable they were to business. So I've had lots of mentors, lots of coaches, and I could kind of blabber off what all of them said, and they all sound pithy and insightful. The most interesting thing, my grandmother, I was very close with my grandmother. I actually lived with my grandparents for a time, and she was the only person I called every single week. And when I was a kid, I didn't really talk to my parents as frequently, but my grandmother I called every single week, no matter where in the world I was. And she would end every single conversation with, "Stay healthy, stay healthy." I was like, "Yeah, okay." Russian grandma's like, "Babushka, it's okay. Like, I'll be fine. Like, stay healthy." She's like, no, you can't do anything if you don't stay healthy. I'm like 19 years old. Staying healthy is the farthest thing from my mind. But, I've over the years, and particularly more recently, realized how critical it is to stay healthy. And I'm not just talking about physical health. I think I'm talking about mental health. I'm talking about spiritual health. I'm talking about relational health. Being able to align the different dimensions of one's world, actually, it changes the way you show up. It changes the way you show up with a colleague, with a client, the business partner. It changes the way that you get excited about what you do. It changes the sense of alignment that you feel. So yeah, everybody's going to index on, you can talk about management style and capital allocation and value creation and all that stuff, but none of that could happen unless stay healthy.
Mm-hmm.
And, after all these years, my grandmother's advice that is finally starting to kind of make its way through. And candidly, I think it's the best advice I ever got.
Wow. Thank you, Mo. That's great advice, obviously, for everyone listening. Thank you. I learned quite a lot.
Yeah, no, it's fun. Thank you.